David, good morning. This is a big deal, and as I was looking through it on my BlackBerry at around about 8:30 this morning, I went through everything. I kept looking for something that actually made me a little bit cautious, but I couldn't see it. I mean, it's going to be earnings enhancing. You're going to save 15 million euros a year, apparently, because of cost rationalization by 2014. It's got a strong management, this particular concern, Nordenia that is. It's got geographical diversity. What's the catch?
Well, I think we are very excited by it. I think our view is that the difficulty of buying a business now is the current economic environment, and probably that's a right time to buy from a long-term strategic perspective. What we like about this business is that it enjoys very good fundamental growth in a variety of its products, in fact all of its major products, both in the mature and the emerging markets. On top of that, as you said, it has a nice geographic global footprint with good exposure to the emerging markets. And we know that everything's slowing down right now, but in terms of the long-term trends, and this is consumer packaging we're talking about, we're likely to see very good growth for these product areas in those emerging markets at higher levels than we'll enjoy in the mature markets. So we really like what we're getting. For us, there's a huge amount of overlap with our consumer packaging business, hence the high level of synergies that we're going to extract from it. We've been able to buy in at a sensible sort of entry level. High level of synergies does generate, therefore, pretty superior returns to us. So we are excited by the opportunity, we like it, and we believe that, sure, we need to recognize it's an uncertain economic environment. Earnings are unlikely to excite in the short term, but after all, we're here to create long-term sustainable value.
Was this a conscious decision to go into the FMCG market? Was it something that you said, right, this has got to be our focus for the future? Because I know that this acquisition means that you restructure your international and European operations into 4 divisions. It's a really, really big deal. Was it that? Was it a strategic decision, or did this particular opportunity just come up and you just couldn't turn it down?
No, we've been building this business for some time in our own operations. We've been building really over the last 15 years as we've gradually moved away from pure sort of industrial packaging to a much higher level of consumer focused packaging, and also move out of pure paper into laminates with other substrates and also plastic. This fits the bill exactly. We've been looking at this business, we've known about it for many years, it's been privately held, and it's not the first time we've tried to buy it. We've tried to buy it historically without success. So this is part of a very clear strategic position that we've been seeking to achieve.
12 operation facilities in 7 different countries across the globe. Where are those 12 operations? The only thing I might say about this is that the European factor might be a little bit cautious about that, but maybe you can tell us a little bit more about this very big operation that you are about to acquire.
Yes, the 12 operations are some are in Western Europe, some are in North America, then in Poland, Hungary, Russia, and China. Now, the reason why we like it is one, it's got that geographic opportunity into the emerging markets. Currently, it is still predominantly, most of its product, more than half, goes into the mature markets. But even in the mature European landscape and with the European uncertainties, when you look at the products that it makes, these are pretty recession-resilient type of products. 40% of the volume is hygiene applications, and that goes either into its components that go into nappies or components that go into femcare products. Those are recession-resistant type products. Clearly growing strongly in the developing part of the world where you get higher population growth rates, growing well in the incontinence and mature part of Europe, as it were. If you go then to the pure consumer packaging side of it, the type of products you're talking about here are very high value products for pet food application, for example. So it's food based, and therefore people consume this stuff, and pets consume this stuff, recession or no recession. So overall, it is a pretty recession resistant type of application, enjoying structurally very high growth rates for a variety of reasons around smaller households, convenience of smaller serving requirements by household, and therefore this type of packaging is very much the trend.
Okay, so defensive, almost a defensive stock in many ways because of the maturity of the business, and as you quite rightly pointed out, recession resistant. I don't think there's such thing actually as a completely recession resistant company, but there's certainly this one seems to display those qualities. It's also got a sort of a blue sky growth aspect to it as well, because there's a greenfields China operation that's being developed at the moment. When do you expect that to come on stream?
Yes, indeed. I mean, that's one of the great attractions here. The China plant's currently in construction. It'll be commissioned by the end of next year, up and running in 2014. That really is a very exciting growth potential. The issue in China often is that, if you don't have proprietary technology, it's difficult to create some competitive advantage versus other operators in China. Here, the proprietary technology, being the compounding and the films, will be retained and operated from Germany, and those films will then be sent to China for laminating, printing, and converting into the final packaging products. So difficult for others to replicate what we're doing, growing very much there in tandem with Procter & Gamble. For example, in the hygiene sector, 75% of Procter & Gamble's global requirements come from this particular business in the nappy space. So exactly growing with Procter & Gamble into China is part of the game as well. So very much, in line with what we've been trying to achieve strategically. As you say, some nice defensive qualities. Nothing's recession resistant entirely, but nice defensive qualities and some very nice blue sky potential for good high growth rates into that emerging market.
The other thing I think from the point of view of a conservative sort of defensive style investor is you look at your customer base, or Nordenia's customer base. A lot of them have been with the company for 30 years. Procter & Gamble has been with the company for 30 years apparently. And am I reading this right, that 37% of revenue is attributable to Procter & Gamble? I mean, that's a massive amount.
Yeah, I mean, Procter & Gamble, the relationship with Procter & Gamble is absolutely critical to this business. A lot of that is in the hygiene area and particularly in the diaper area. Yes, 37% of the revenue is to Procter & Gamble. That is under a 4-year contract, which keeps on being renewed. They've been working with them for 30 years. And as I said, they supply 75% of Procter & Gamble's global requirements in this particular component sector. So very, very closely linked to Procter & Gamble. The same is true for a number of other major FMCG customers for Nordenia.
Let's talk about the semantics now and talk about the numbers. What are you taking on here? I noticed there was a bond that you're taking on, obviously, with a coupon of 9.75%. Isn't that a bit glamorous in these days of almost zero interest rates?
Yeah, I mean, I think unfortunately that financing structure was there. We inherited. Ideally, we would not have. It would have been cleaner had they not had that sort of financing structure, and we could have taken it over and financed it 100% based on our normal financing structures. But that's one of the disadvantages in the deal. The balance of the funding will come from new debt raised from our side, which we have put in place an extra facility for that to make sure that our existing facilities remain fully available to deal with any other eventualities that might require.
Okay, so it's not going to stretch your balance sheet. You're happy. I mean, you're not happy with the 9.75% bond coupon that we've just spoken about. Is it going to go ahead? I mean, it's obviously just subject to the niceties of regulatory approval and that sort of thing. But you're confident in the fourth quarter of 2012 this deal will go ahead and immediately enhance Mondi Group's earnings?
Yes, I think the probability is very high that there shouldn't be any major issues from the antitrust authorities. Clearly, it has to go through that process. That process will now commence immediately following the signing. But we don't expect issues to evolve from that, and therefore we anticipate closing to take place in the fourth quarter of this year.
David, thanks so much for your time this morning. That's David Hathorn, who is the CEO of Mondi. I would just say